So Edison's new report, which is Normalization Augurs Well for Exploration, looks in principle at the value of in-situ ounces, in-situ resources in the ground, that is to say their value in the ground. It looks principally at gold, but then it expands these out to other metals and minerals as well. Suffice it to say that as far as this report is concerned, whereas the value of an ounce in the ground used to be $10, on average, across the three markets that we look at, which is London, Australia and Canada, we reckon the average has now risen to 16. So that's a 60% increase in and of itself. Much more importantly, compared to the cost of discovery, which we reckon on average is $9, whereas the uplift used to be marginal and certainly not enough to mitigate the exploration risk. Now the uplift is almost 100% on discovering an ounce in the ground, and that is making the whole sector look a lot more attractive. More importantly, differentiating between the three markets that we see, what we see is that the best valuations on average are now in Australia, whereas 2 years ago they were the worst valuations. The second best are in London, the third best in Canada, which seems to be lagging, whereas all the markets are now normalized in terms of the value of measured ounces is higher than the value of indicated ounces, which is higher than the value of inferred ounces, and the value of the average ounce is somewhere between all three. But what is very noticeable is that Canada gives really, to all intents and purposes, no value for indicated and inferred ounces, and has shown very, very little recovery from the nadir of 2 years ago, whereas Australia has shown one might say almost a spectacular recovery, and London has shown a very appreciative uplift as well. So that is the broad picture. In terms of what it means for the individual markets themselves, and if you look at that return on a company which first of all starts with cash, and then it moves to inferred ounces, and then it moves to indicated and inferred ounces, and then it moves to measured ounces, it's very noticeable that most of the markets, to be honest, they're not giving much value for inferred. Canada certainly seems to give a negative value, i.e. they're worth less than the cost of actually delineating those ounces. But then you have Australia and London certainly give value for indicated. Canada, again, falls at that point. And then all three of them give a good return on measured ounces. You expand that out to the rest of the market. On the next slide, what you'll see is that what we try and do is we try and take the value of let's say an average ounce in this case, which we said is $16, and then we said what is that as a percentage of the price of gold, and the answer is about 1.3%. And so we've plotted that on the y-axis against the spot price of the metal or mineral on the x-axis. So what you have, if you like, in the x-axis you have a proxy for economic scarcity, and that's the price, and we put all the prices in dollars per ton, so gold for these purposes, while of course we normally think about it in dollars per ounce at $1,250, $1,300 an ounce is actually about 40 million US dollars per ton. And we put that on a log scale simply so that you can see you can see the scale, because otherwise you wouldn't be able to see gold on the same scale as you could see iron ore. And then we plot up the y-axis, the value of the in-situ resources as a percentage of spot. Now, when you do that, what is very interesting is two things. One is you get an obvious straight line through those points. You can see that there are 6 points which are above trend and everything else is below trend. And if you look at those 6 points that are above trend, one you've got the arithmetic value of gold, and you have silver, so if you like, those are the two historic metals and minerals. But then you have 4 more metals and minerals which are relatively new to the financial market. So you've got tungsten, you've got graphite, you've got lithium, or rather specifically lithium in spodumene deposits, and you also have bauxite as well. So if you like, those are probably the areas where, if you assume that it's going to cost more to discover the rarer, more expensive metals and less to discover the more common, less expensive metals, then probably you're getting your best return on your exploration dollars by looking for the bauxites, the lithiums, the tungstens, the graphites. You will also get a good return almost inevitably from gold and silver and all of the rest of the metals. You can certainly get a good return on those as well. However, they are more in the typically traditional area, if you like, of the market. Another analysis we've done, which is just to compare how those in-situ values as a percentage of spot, how they've moved over the course of the last 1 and 2 years. And what is very, very noticeable, and I think gives credence to the analysis as having fundamental meaning in the markets, is you can see that the very dramatic falls for the likes of vanadium, which used to have a very, very premium rating. Now that has come back and is much more in the middle of the pack now. Some markets you will see there has been a bull market, and yet the in-situ value has gone down. More interestingly is where you see a bear market and the in-situ value has gone up. Nickel is a notable metal in that respect. Also sulfate of potash is one of those as well, where there has been a bear market and yet the valuation has gone up. And that suggests that the market is trying to normalize. So it's all part of the normalization process that we see in terms of metals and minerals. By and large, it has been a bad, if you look at we looked at something like 15 metals and minerals in this particular analysis, and the majority, approximately 10, were in a bear market over this period. So the fact that valuations have gone up, it's a strong indicator that the market is normalizing from levels that could not be sustained, that were unsustainably low levels. We're still very, very far from a bull market. If you look at a bull market, if gold is now trading at 1.3% on average of the spot price, at the height of the bull market it was probably 11%. If you look at something like iron ore, which is closer to 0.1%, at the height of the bull market it would have been over 1%. So the point is there has been some normalization. The analysis has some fundamental credence, and in terms of where the market might go to, well, it's 1/10 of the way there. So the potential is things, if we would see a full return to a bull market, things could still be 10 times higher than they were. We're still much closer to the bull market, to the bear market, than we are to the bull market, and it's all to play for.